Just confirming, are you guys okay with this being recorded?
Yes.
Yeah.
All right, welcome everybody. People are coming in here, so we'll let everyone filter their way in and we'll get started in just over a minute. Jerry, John, how are you?
Doing well. Thank you.
Good.
You?
Well,
All good. Chicago in the summer, you can't beat it. Jerry, you're in your Tampa office there?
yes, in Tampa, in the home office with the birds. So the birds could be flying around and add some excitement.
How many are you up to now?
I had 2 in here, but they're maybe 15, 20 scattered throughout the house. But my 2 favorite ones are in here.
All right. Do the non-favorites know who's who?
You've heard that term bird brain. They're not that smart.
And John, where are you at?
I'm in Greensboro, North Carolina.
Love
So nicely humid here today, bird free.
Yeah, as am I.
We're still trying to work up to Jerry's level and just maybe one at a time. Not going to jump to 15 or 20 yet.
No. Why would you?
Why would you?
Mine's a rescue, and she was forced on me. And I didn't like birds. Didn't think I liked birds, but then one thing led to another. And now we're a couple.
Yeah, there's something soothing about it, right?
Mm-hmm. Oh yeah, they're great pets. I mean, the best. And I have a lab and Shih Tzus and dogs, but the lab is special. But birds, there's a bonding thing going on there with the birds.
I hear him. All right, everyone, we'll give it just another minute here. We've got a few more people coming in. And then we will get started. Right, I think that looks good. The pace of people coming on has slowed, so welcome everyone. I'm Jeff Malik, one of the partners at RCM Alternatives, where we've worked with Jerry and John for quite some time, 5-10 years, if not longer. But I don't want to show my age too much. But we're going to talk trend following today and TFPN in particular. So Jerry, let's start with you. We're going to kind of do this podcast style. We're not going to have any slides or anything. We're just going to talk the talk. So Jerry, just give us a little background. I'll call you the man, the myth, the legend in the trend following space. So how'd you get that title of legend?
I don't know if legend is that great. When you're my age, you kind of don't want to be a legend. But so I was in the Richard Dennis Turtle program, and after 4 years of doing that, started Chesapeake in 1988. So a long year, you just got to survive. Survival is important in markets and in trading, investing. So I've been able to survive the ups and downs. Love trend following, always loved it. I loved it before I met Richard Dennis. So I was just fortunate that he liked it as well. And so, yes, my lifelong pursuit.
Love it. And John, give us a little background how you got involved with Jerry and what you do.
Yeah, not nearly as exciting as that. I came to trend following having done all the non-trend following stuff first. I started out in market making and equity research, which is probably heresy on this call. But, like Paul to Damascus type moment where the scales fall from your eyes. I read Michael Covell's books and instantly connected with it. And, in those books is one Jerry Parker, right? So started a CTA in 2007 and ran that until we started Blueprint in 2013. And so Blueprint's really comprised of an asset manager and fund management company on one side and a wealth management platform on another. How we got to know Jerry was we wanted to get to know Jerry before we did. We used, so, I sort of come to this from two vantage points. When you think about TFPN, we're both a sub-advisor to it. So understand the gearing inside, but also as asset allocators from a sub-advisory perspective. We were allocating to one of Chesapeake's mutual funds as part of our asset allocation, or, models, strategies, et cetera. And so that became a material holding for us. And that's how we got to know them probably 12, 13 years ago now.
All right. And Jerry, give us two good stories from back in the day. 1980s style trend following, what it was like back then versus today.
Oh, wow. Um,
For one, there were pork bellies were trading. We don't have that market anymore, right?
well, one of the most important things about trend following is to keep expanding your markets and have a portfolio of as many different markets as you can get. Now we've sort of added crypto futures, small allocations to some crypto futures. But back in the day, we only traded probably 15 to 20 markets.
Mm.
And I remember coming in and every morning at 7:30 and seeing the yen. I would have a big move, and really it never crossed my mind that the yen had been trading all night. And so when you get into the real world, away from Richard Dennis and that kind of real support group, you start learning a lot of things that you didn't really have to pay much attention to. So, but certainly the markets, the number of markets now with the single stocks, it's just gotten better and better from that perspective over the years.
Love it. What were some of the 15? The standards, bonds, gold.
Wheat, corn, and beans. I don't think we traded copper, silver, and gold. We did trade maybe crude. I was there when I think heating oil came out first, and the very first big trend for the CTA for the turtles was Feb heating oil, 1984. Not January, not March. It had to be Feb. The harbor in New York City got frozen, and they couldn't get the heating oil in at that point in time, and it sort of went up to over $1, I think, which was a huge move at the time. So right off the bat, we had a monster trend that we were, told never miss a big trend. So probably half the room kind of missed that big trend. Not sure how coming out of the turtle class what excuse we were using to miss that trend, but that was an eye opener to see something so fun and happen right at the very beginning.
And both of you, John, you can weigh in on this too. How do you guys think about 1984? You were trend following. It's basically before cell phones, before the internet, nearly before the personal computer, right? Maybe there were a few people with them out there, but essentially before all this technology. There's no other technology from 1984 that we use today. Maybe sonar or something like that, but right, like how can something have survived that long with basically the same structure? Right? It seems like antithesis to the modern world we're in, of like, hey, the beauty of it is in its simplicity, right?
Yeah, I can go first on that. I think the very nature of universal principles is that they're time independent. So when you think about trend following, what is a dependency of trend following? Well, the way we do it, I think collectively, but I'll speak for John and Blueprint, the way we do it is it's price only. And so if the universal principle as a trend follower, risk manager, which we sort of see those as, two sides of the same coin, as long as you have prices, that's the key variable. So you've been able to trend follow. As long as you have had prices, you have been able to trend follow. And so it's robust in that way, in that it's not dependent on, I've heard Jerry say, and he's here, so he'll say it better, but it's like, the core principles are hard to improve upon. You can improve incrementally over time, but the things that worked years ago in terms of using price, ignoring everything else, employing discipline, to us, these are universal principles, and they'll probably, I would say maybe the bet we're making is that, 35 years from now, they work just as well as they do now, as well as they worked in 1984.
Jerry, I think that part of me is, well, I'll ask a follow up. Is part of that price reflects everything, right? It's the ultimate scoreboard. Like no matter what's going on in the world, no matter what technology we have, new, old, the price of each commodity, each stock is reflecting all that newness. Like you can't hide it outside of the price.
Probably as good or better than anything else, and you can do some back testing and research to see uh, what it looked like in the past, at least. And there, there's some secret fundamentals out there that you don't that can show up in the price. I know sometime during the '90s we were buying crude right before the Iraq invaded Kuwait, and so somebody else was buying crude who knew that fundamental information, which was pretty important. And so that can happen as well, where people will move the markets prior to anyone really knowing
Hmm.
why it's being moved. So that's kind of fun to watch as well.
And now that you mention it, let's talk about, right, this time last year, the tariff tantrum or whatever we want to call last April when we were on again, off again, was not the best period for trend, right? It was real whipsaw. A lot of the articles started coming out like they always do. Trend is dead. It stopped working. Markets move too fast. All that stuff. And when you know it, right from around the fall, trend had a pretty good comeback, based in no small part on the war this time, with the energy complex. So, talk a little bit how you, Jerry, over the years have survived those down periods, and kind of have, is it pure faith, or is it just math that you have have the belief that the models will come back?
Well, I think regardless of your models and your math, you're just going to be you're human, and it's going to really hurt and sting. And you really don't really can't really think that, well, just because I've done it in the past or the models have done it in the past, that they're going to continue to do it in the future. So no one is immune from really feeling bad about losing money, your own money, your client's money. It's money and it's pride. But the great thing that we have going, is that we have a process and we have a systematic process. We download the data, we run it through the computers. The computer spits out the trades and the positions every day for tomorrow, and we don't have the ability to kind of step in there and do a discretionary trade. When we don't exercise, I guess I could call up and shut it all down and do a discretionary trade if I wanted to. But over so many years of just following that philosophy, and I remember that was a particularly incredibly bad time, and we were all kind of like wondering what was going on, and the money we were losing was pretty dramatic. And I remember like having a phone call the next day about our positions and our trading with our team. And everybody was just on the phone, like nothing that was on their mind except we have our work to do, just like every single day. And so when you need a group of people with that kind of attitude, no one to tempt you. Hey, don't you want to step in and do a Jerry trade to reduce some of the pain and suffering? But whatever it takes, whatever you need to do in order to maintain that level of discipline. Fortunately for us, we haven't, even when we haven't maintained that level of discipline historically, especially in the beginning, it's never worked out for us. It's always been better to just follow the rules, follow the system. And at some point in time, maybe you step aside when things calm down and make some adjustments and do some more back testing and research. But it's just really important to get to that level where you realize the best thing for you to do is continue to do the system trades.
And then do you think, right, by not tinkering, you're always going to be in each trade in the same manner? So you're almost, right, you're securing your ability to be in the next trade when it becomes a winner, right? Like by not choosing, you're self-selecting that you're going to be in when the good times come.
Exactly. And you have to have a money management system that will come in and reduce risk during extraordinary times. But you want the system also to not have that sort of risk control built in, to where it's very infrequent that you're going to need to trade smaller, for instance. due to losses. But you have the rule, but you also have a system that is well diversified. It already takes small losses. And so you don't really, you're not stepping in and being tempted weekly or monthly, but maybe every couple of years to um, reduce your risk. And then what that does immediately is you've taken care of that. So now you just go right back to following the systems, not picking and choosing trades or positions. So it really is the way to do it. Everything should be a slave to um, how can I devise my system so I can do the trades and not have to have a onerous money management strategy that really comes in and stops being the systematic trader that you were until things kind of settle down. That is just going to cost money.
Yeah. And John, what have you seen over the years? Is it, you think it's human or statistical or something else when, right, out of these downtimes come things that you didn't expect? No one was expecting us to attack Iran. Maybe some people were, but right, like, and trend following didn't care what the catalyst was, but you get these long sideways periods that kind of tend, it's like a spring that gets crunched down and then it's going to pop back out. You think that's structural, that's part of the markets, or is it human that we kind of get, comfortable until something snaps us out of it?
I think it's probably a little of both. I think it's structural in the market sense, but exacerbated by humans. I mean, because if you look back, I would say based on last year and then the subsequent catalyst to, bring put trend back on the map or resurrect it once again. You look back over history and you see these happen over and over and over and over. It's just like declines of, 25, 35, 40% in equities. Nobody that's looked at the data or has operated for any amount of time, at least a few full market cycles, should look at that and be surprised. So to us, it's time frame selection. How quickly are you going to respond to those things? Because, you can, in a sense, make a choice. It's not perfect, but for illustrative purposes, you're making a choice. So you can design trend strategies that are super short term that are going to pick up the tariff tantrum beautifully, right? And if you're long short, like what happens in TFPN, you could have a very short term system that shorts pretty close to the top because it's super responsive, buys closer to the bottom in a V type, market structure, quick down, quick up. And it's going to look great in that period. And then it's going to be terrible in all other periods, right? Or far less optimal in other periods. So the way we look at that is, okay, if that's true and the data backs it up that it has been, well, we're sort of making a bet that it will continue. You have to choose what are your goals and what time frame matters to you as a result of that goal, and design systems to pick that up and take what happened last year, the drawdown, even, plus or minus 3 to 5 months on either side of that is part of it. And also arguably part of the moat of trend following, answering the question, why doesn't everybody do it?
Mhm.
Because those periods suck. But then you get this, right? So if you gave up or didn't have the discipline or lacked the necessary discipline or systems to pick up on what's happened in the last 12 to 15 months because of a period of time that was totally predictable, not the timing, but the action itself. So our thing is we look at that as a cost of doing business. It's not easy. I'm not pretending like it's easy, but it's a cost of doing business.
Right. It almost flips the an equity investor, right? You're owning stocks, you're owning SPY or QQQ or something. You're expecting frequent small gains, right? And you're risking some big, huge outlier spike down, 2008, 2000 kind of spike down. Trend following's the opposite of that, right? I'm expecting some large outsized gains in energy markets, in cocoa a few years ago, weird markets. Respectfully, I love them. I'll call them weird, but respectfully weird. But you're exchanging sometimes small, frequent losses, which is the opposite of what everyone expects. Jerry, how your brain must have been born differently because you've always kind of got that intuitively, right?
Well, yeah, I mean, I love if you get too far away from diversify, take small losses and let profits run, I'm getting uncomfortable. So
Mhm.
we expect, and that's a challenge every day. You know, when are we going to get those big trends? Um, and taking small losses, you know, that's probably not that difficult. Diversifying is kind of fun, but there's nothing more important in almost any kind of investing is not to cut those profits short and don't panic and don't try to book that profit too quickly. Let those profits run. We've all done it. We've all wanted to get out and book it. It's ours. We've already spent it. We deserve it. And I think that's one reason why trend following, you know, continues to work. You know, the parameters will be changing. We trade a lot longer term than we used to. We'll be changing the parameters and maybe hopefully coming up with some better ways and additional ways of identifying trends. But um, the markets, the trend following probably is going to work for a long time, just given that it's so different from what human beings prefer. No one really likes 40% winning trades, lots of small losers, um, and waiting for 5 to 10% of your positions to make all the money for you on an annual basis.
Yeah, it's we're conditioned to think of it the other way. Let's circle back to the war a little bit here because I think people like they've seen gas prices increase, they've seen crude prices on the screen. Like how does your portfolio construction work where those markets are part of it, and talk a little bit about how those markets have done kind of in this environment?
Well, for me, the way we set up the portfolio, it's strictly based on diversification and trying not to do too much over optimizing on diversification and correlation, but more of just a common sense of having a lot of currencies and a lot of commodities, interest rates, and stocks, and maybe some stocks that are commodity based, but lots of different types of markets and lots of diversifications. And then we're going to have the longs and the shorts as well. Um, but never would we put together a portfolio based upon historical performance. Like, you know, there's all the markets over time are probably going to have similar performance, but there is the best performer out there and there is the worst. And so you don't want to pay too much attention to that. Just, you know, cocoa is a great example. Cocoa is an example of any point I ever want to make about trading. I can
Yeah,
twist
love
that
it.
cocoa trade into like anything. And, you know, cocoa went 10 or 15 years with no profit. It probably broke even at best on the historical back test. And then all of a sudden, it's one of the greatest trades of all time. So that's exactly the way we approach it.
But that's such an interesting, right? Like, why would you have it in the portfolio? Like the
Stri-
classical portfolio composition would be like, kick this out. It's not doing anything.
right, right. Strictly for diversifying purposes. You know, CTAs are totally fine trading markets that have never made money or haven't done very well. And so cocoa is a good example. You want it in there um, because one of these days it probably will do well and you'll be really happy to have it in there. But in the
Is a more
meantime,
sorry, is a more statistical view of that. It's like a neutral carry at best, maybe small negative carry. Like it doesn't cost you that much to have in the portfolio for when it might be 2 years from now, 5 years, 10, 15 years from now, it pays off. Like that's the math behind it, right?
but I think the math really is even better than that. It is that cocoa could now become one of the best performers in the future. It's not
Mm.
destined to be a negative. And as I said earlier, I think my philosophy, math philosophy of trend following is all of these markets are kind of created equal. They're all over time approaching, they will start to approach the average return of all of them. So the bad ones will get better, the really good ones will get probably a little worse. And in an infinite amount of time or in 100 years, the back test of all of the markets that we currently trade will probably be, they'll probably have about the same positive expectation. And that's my philosophy. And that's how we've operated.
And you've been doing this for nearly 50 years. So you're not just throwing numbers out there, right? Like you've seen it over actual data over 50 years.
Yeah, but I have a tendency to dig down deep and understand the rules and the philosophy and stick with it, regardless if I've ever seen it work before. I'm thinking it's probably going to work. And I think that's a key too. Yeah, that's trend following. There's not a lot of creativity involved. I listen to podcasts, your podcast, and there's a lot of interesting people out there. I think classic trend following is not nearly as interesting. You don't have a lot of freedom. The philosophy and the numbers and the math kind of limit, overweighting something and proving that you should be, regime change. I have no idea what that means. I sort of don't, when I hear terms like that, I go out of my way to not understand them because I don't want it to um,
Yeah.
infiltrate my trend thinking.
Well, you're not a good CNBC guest, right? You'd be like, hey, what are you
No.
doing? And they'd be like, I don't care. All these markets are created equal. The producers in your ear are like, stop. Talk about how this one's so great.
Oh, I
Um,
know. People have told me you need to get him to tell you where he thinks the markets are going. And they're like, he refuses to do that. Okay, no longer a guest.
and John, talk a little bit. Jerry's going to be very egalitarian in his market selection there, but talk a little bit what you've seen in the portfolio construction of it. Wasn't just crude oil
Yeah, no.
during this period. It was the diversification into the entire energy sector, including energy stocks, right?
Yeah, exactly. I mean, you got heating oil, you've got uh, gas oil. So that's not just U.S. based energy, right? It's European based energy. It's global energy, and you've got all these individual stocks in there. Total, Suncor, Kodiak Gas Services. I mean, that just describes the breadth of the portfolio and what could be bought or what could be shorted. So the sample size of potential markets or positions is, at least from my perspective, as wide as anything that publicly trades out there, any ETF, any mutual fund. We've yet to see a set of markets or a portfolio constructed with such breadth. And so, but we haven't talked about metals. I mean, you've got gold, silver, and copper. So you must have had some amazing moves outside of metals during that period or subsequent to it to not talk about metals. Yeah, 4 or 5 months before it.
Right. Gold was down 20% one of those days in February, I think.
Yeah, and silver had its largest down day ever, or at least back to when we have decent data.
Yeah.
And yet they were some of the best markets, over that, let's say an 18-month span leading up to that. Still are. So, we really like a philosophy based on you go where it's good, and it doesn't matter what the name of the market is. It doesn't matter what you think, and we're not pretending. We're just going with whatever's moving. And sometimes a lot of the positions move together at the same time. And, in the example of cocoa, that was a particular period where not much was really trending, maybe outside of equity indices, the top heavy indices. So maybe the top 10 stocks, Mag 7, whatever, they were trending at that time, but cocoa was kind of the only thing moving. And so, the portfolio is treading water. In a majority of the portfolio is either flat or treading water, long or short. And then you have this huge outlier that it can take advantage of. That's trend following in its purest form.
Well, Jerry's got some of his friends joining him here. Jerry, introduce us.
This is Petey, and that's Banana.
Banana.
So they want to get on. They want to get on camera.
Yeah, welcome, guys. And the cocoa trade's interesting to me because as a client, right? Like, what am I going to do? Call up my wealth advisor and be like, hey, I'm reading some weather maps in Africa, and it looks like there's going to be drought in Ghana, and I want to have some cocoa exposure, and let's talk through the sizing and how much no way. That's outside the realm of any reasonable conversation. But here you can invest in this, which dynamically and automatically gives you that exposure, gets you into such outliers, which is totally uncorrelated from anything else in your portfolio.
Yeah,
it's a safe way of getting things in your portfolio that you really have no other way of doing it, because the buy and hold is not going to work in almost any of these markets that we trade, except a stock index. And diversification for a lot of people is the different classifications of stocks: small, mid cap, large, international, private equity. And we're like, no, 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 let's get some real diversification in there with the currencies, commodities, and interest rates. And in order to get them in there, we're going to have this trend strategy that takes the small losses, hopes that the price is going to be a good indication of when we should be buying and selling, and wait for these big outlier trends. I mean, there's really not a lot of different ways of. You've got gold that maybe some analysis will show you buy and hold. Yes, it makes money. I can have gold. And maybe Bitcoin is a more recent entrance in this. What can I put in there that buy and hold is going to do well? And the whole world is out there for us because we're not going to buy and hold. We're going to use trend and the risk control measures and even shorting to really add something to portfolio that you really can't get anywhere else.
Just quick programming note here. I see a couple questions in the Q&A. We'll get to those in a minute. If anyone else has questions, go ahead, click that button and throw them in there. But want to switch tone a little bit and talk about two things. One, TFPN you chose that name on purpose, plus nothing, right? Is the PN. So a lot of programs out there right now are adding stock beta and adding some different things to kind of make the medicine go down, so to speak. What was that decision to be plus nothing?
Well, I think it's two things going on there. One is a pure trend product. And if you want short term trading, pattern recognition, carry trade, things like that, then it's fine. But this is a reliable product that's going to be trend only. And then another way to look at it is with all these markets, hundreds of markets, long and short, all the different asset classes, systematic. You don't need anything except trend following. That's maybe a little bit more controversial. But we have your stocks and we have your bonds. But this is a product in a fund that says everything in your portfolio needs a hard stop, a stop loss, a trailing stop. And for money management and risk reasons, you're not losing markets. You're getting all the markets that you trade that you have in your portfolio, plus a bunch of other ones, with a different way of looking at markets rather than just buy and hold. It's going to be systematic trend following, taking those small losses and letting those profits run. And I think to some people, it's the greatest thing. When I first heard about this, I was like, this is fantastic. I was 25 years old. It could not be better. And then as the years have gone forward, we just added markets, gotten better, more diversification, and I've loved it more each day. And yet the industry is like, how do we educate people better? How do we make them see this? And it's just like, I think to some degree, it's just like, if it hits you and it makes sense and it hits your personality, you're going to do it. When you get the basic education about it, and then some are like, no, this does not resonate with me, and I respect that. And
They're like, what do I talk about at the cocktail party?
well, they're not going to talk about this, but
You talk about cocoa. Yeah.
Yeah.
Exactly.
And then secondly, talk about this which I thought I would never see the day, but you were early on this. I think we were talking like 15 years ago, had lunch in Tampa, and you're like, you don't invest in the commodity index, you invest in all of the different commodities. So why would you invest in only the stock index instead of the individual stocks? So part of TFPN, part of the trend following is on individual equity names, which is quite unique in the space. So kind of talk through how that works and why that decision was made.
Yeah, because it just gives you more diversification, more outlier hunting. The average of that an index average approach is gonna you're gonna be long some stocks that are in downtrends. You're gonna be long stocks that are flat and not moving at all. So this just lets us break open that index, treat each individual stock on its own like we would all the other markets, and maximize these outlier trades. And diversification. We could have our shorts on, we could have our longs on, And like you were hinting at, no CTA would trade the dollar index only or commodity index only. Why would no one would ever give up all of that wonderful, beautiful diversification and all these trend following systems, multiple systems with multiple entries and exits. It's just a beautiful portfolio and a strategy and a setup. But then let's just throw an index in there that's kind of built for buy and hold and works well for buy and hold, but it's not going to work as well when you have a strategy that's really making money on outlier trades. And the index, by definition, is going to average things and not allow the type of movement that you're going to get on an individual stock.
Yeah. And John, do you think we changed that, right? Like some of these moves off the lows in February have been insane in the stock market, but is that just same as it's always been? Like think back to 99 or something?
Yeah.
Or do you think we have more intense single name movements these days?
I don't think we do. I think the intensity of the single names is as well, today is what it was in 90. Go back to any period where you have, borderline parabolic moves, and that doesn't just resign itself to stocks. I mean, you've always had markets that are increasing at an increasing rate at some point. I don't think the data shows that those are getting more prevalent or the magnitude of those moves is getting stronger. Now, you sort of take a next step logically and you start to think about, well, okay, but is that an analog to other bubble periods, or is this, not bubble? We don't have an answer for that. We're ready either way. I would say also just one quick thing about the breaking open the indices and using the individual names. What we've experienced there is the more granular the portfolio, if you're employing a trend following strategy, the more granular the portfolio, the more influence trend following has over the portfolio. And what we've noticed is, okay, trend following applied to something, built for, like Jerry was saying, potentially a retail investor, somebody seeking economy in how they're selecting investments. I want one of this and one of those. The index is a good place to go. And applying trend following to that over a full market cycle or multiple full market cycles tends to work out really well. But as you break down the index and trade the underlying positions, both because of the outliers, but also because you, in a lot of cases, are bypassing the meat of the largest down moves, right? Because the index constituents, when you look over time, there's been a lot of studies. This is in our data. We've just been reading it. It breaks down into it's a fairly non-normal distribution in that it's fat tails, right? So you have even this year, markets having a decent year. Yeah, we've had some down volatility. I'm talking about the S&P, but you still have some stocks down 40%, 45%, and you have your positive outliers up, God knows what at this point. So but it's a both and. You're both capturing those up moves, maybe not 100% of the move, likely not 100% of the move on the upside, but you're also avoiding those big detractors from performance. And you mash all that together and you tend to do a lot better than just using the index itself.
And worth noting, we're talking long and short, right? So
yes.
Yeah, if these AI valuations turn out to be crazy and there's chaos, you can be short a lot of these names in a big 08 or 2001 type sell-off, right?
Eventually.
If you're looking at each individual stock, from the short side, let's say, then you come into April of 25 with shorts on. You're not scrambling going from long indices now to short indices because they're pretty much all in an uptrend. And you come in with bad periods with usually some longs and shorts on, just like you did in all the other markets. There's an amazing amount of diversification in equities if you take the time to set up the portfolio. How? The same way, which is creating an equity. The equity part of your portfolio is going to be companies from different sizes, different countries, and different industries.
I have shorts on right now. Is that what you meant?
I doubt it because I've I've seen your podcast before. Yeah.
No, I meant actual shorts on my body. The
I know.
yeah, yeah.
That's what I do. Yeah.
The it strikes me like if I'm using all the E-Trade and whatnot tools, I'm like filtering, like, okay, I want a stock that could go up 10x and I want it to have enough liquidity and I want it to have this, and maybe it's a breakout. Like I have to use all these tools and do all this work where you're saying like, hey, we do all this work for you automatically every day. Like we are that machine that can filter all this and get you in those trades, long and short. Right?
That's right. It's all
Yeah.
dependent upon the trend.
But it's like why are people doing so much work to try and identify the things when there's models out there that do it? I'm the old
Yeah,
man screaming into the void.
the one thing that, from an allocator's perspective, that we like about TFPN is that, in the plus nothing part, is that it gives us, we're not surprised.
Yeah.
It is, there's precision in what we expect from it. Now, that's not a commentary at all on directional performance, right? But we know that the manager running the core strategy has been doing this as audited record back to, 94 in one of the funds that ultimately became TFPN, but 89, 88 maybe. Sorry, Jerry, I should know that, but 88, 89, all the way back to 84, operating trend following strategies in futures markets. So there's a predictability in what we expect and what actually happens, which really for us, it lowers the risk of the portfolio just having predictability, which I think is also a reason that index funds have, they're cheap and they've got some other attributes, some good, some bad, but there's a predictability there, right? In certain environments exactly how the thing should behave, and it's going to behave like that. And so when you start introducing other things, even if they have a positive expectancy and will be, accretive to the portfolio over time, with ETFs exploding how they have, and you being able to very precisely calibrate portfolios using the exact exposure you want, predictability is a lot less expensive than it was, and it's a lot easier to attain now. So we like that attribute of it.
Yeah, I've always said that the allocator and manager are often at odds there, right? Because the allocator wants something very specific. I want to put you in this box to do this one thing. And from the manager's standpoint, if that one thing doesn't make money over 3 years or something, like the allocator's not upset necessarily because that's what it's in there for. But the manager's like, well, I need to make a career here. So yeah, a lot of managers start to change things and add some beta and add this and add that so they can survive. Can't blame them. But yeah, it hurts the allocator's decision of like, well, how am I supposed to rely on the profile I want?
We use a box too. It's just a big freaking box.
Yeah. All right, I'm going to hit you guys with some of these questions. Anyone else have some? Throw them in there. So I'm going to take kind of this last one first. What have been the trades driving the nice gains in TFPN over the past 6 months? I think we touched on some of them, but yeah, if you got anything else to expand on there, you want to take that one, John?
Go ahead,
Either of you,
John.
go for it.
Yeah, I'll jump in. Well, from we talked about it's a mix of equities and some metals and energy stocks and futures markets too. But Lumentum is probably the largest driver on the equity side, or among the top three in terms of positive attribution. Western Digital, gas oil, heating oil, Bloom Energy. One of our favorites is Carpenter Technology. That's been on a tear, and it's been in the portfolio, I believe, if not since inception. So we're coming up on the 3-year mark for TFPN right in July. I believe Carpenter Technology has been in the portfolio, if not the entire time, almost the entire time. So long holds, compounding over time.
Love it. Here, I'm going to go. There's another one that's kind of current and then 2 future looking questions. So current, I'll just read this. It's a great question. Jerry, I've heard you many times. Thanks for your expertise. On one of the Aussie Turtles podcasts, you spoke about having 4 systems to trade with different time frames. Can you expand on the time frames, what that means exactly?
Which, yeah, is holding periods. And so we have a shortest term system, the longest term systems, and then 2 in between. They would just, on average, how long they hold positions. So you want to kind of diversify your entries and make the market have more trend before you put the whole position on. And then the exits are pretty important, especially on these big outlier trades. So you have the shorter term system that gets out quicker, and maybe the market turns around and you only have to buy 25% back when it hits new highs, or maybe the big trend collapses and you get out gradually over 4 different areas. And so it's just a way to take your strategy, and most of this idea of multiple systems, they're going to tend to have similar performance historically, which is good. That's what you kind of want. You don't want an inferior um, strategy. And then but not on any one single trade. This important trade, this trades we're in today, these are the most important trades of our life, right? Because we really want to make this money and we want to have this good performance. And so you kind of want to not put all your eggs in one basket and have some different exits, and because you can't really predict, what's going to work this time over the whole data set. In the future, all probably going to work about the same. But we still care about this current period and these current trades, and we want to sort of diversify our profit and loss the best we can.
And the math works out, right? If you just, for sake of argument, say at a 10-day look back, 20-day look back, 30-day look back, 40. Those were your 4 time frames. I know you go a bit longer than that, but for sake of argument, for me to do the math, that's an average of 25-day look back. That portfolio of doing all 4 time frames is going to look totally different than just running the 25-day look back, right?
Well, it's going to look exactly the same during the big uptrends, let's say.
Mm.
Oh, yeah, we want those systems to be 100% correlated in crude. Because we don't want to, we want to make that money in cocoa. But when we do see the trend turn around, we will start playing some probabilities that, okay, maybe this is the end for cocoa. We get out of a little bit of it. Nope, not quite. We got another leg up. So we got 75% of the position left in this example. And we have to get back in on the other 25% at the new highs, something like that. So just a way to get out of a all or nothing idea, where it's going to be a little diversification on the exits. Especially, it's really important on the the exits of the big trends.
Well, when you got diversification tattooed on, well, it's not on your forehead. I can see your forehead, but somewhere, like it's time frames as well. It's not just markets and not just inside the stock indices. Like that, you bleed diversification, you're going to do it in time frames also.
Exactly.
All right, another one here. How would an unexpected interest rate hike affect this?
Well, it depends on what your position is. Right now, I would say a little unfortunately, we're probably short every interest rate on the planet, because that's where the trends are, and there's not a lot of diversification in that. Sometimes the sector, we trade maybe 30 different interest rate contracts, and there's not a lot of diversification right now. So it'd be really great right now, but I think probably what the person means is, um, what could happen? What could happen with the opposite? If we had a rate cut, yeah, we would suffer. But that's a small part of the portfolio. 15% of the portfolio thereabouts is in interest rates, and hopefully we'd get some good movement and some help in the other sectors, um, regardless of what happens. That's sort of the strategy. There are times, April of 25, where I think everything lost money, and there was no refuge anywhere in all of our great ideas about diversification. And in fact, we trade a little bit larger because we have such great diversification. But during that period, we were trading a little bit larger, and there was no diversification. You just can't predict these things. It's not perfect. You're going to run into situations where taking your small losses is really going to help out, but not as much as you wish.
Um, love it. I lost my train. Oh, I was going to say, like 2022 is kind of a poster child for trend during a rising interest rate environment. Stocks aren't working, bonds aren't working because rates are coming up, bond prices going down, and trend for the most part caught most of that. All right, I'm going to go one. There was one more new one here on this, and then I'll finish with this futuristic one. Hi, Jerry. Appreciate all you've done in the trend following space. Been a trend, parentheses, trend follower, maybe means a follower of you for a while, and a trend follower, a double follower. If you, I like this. If you'd still trade a market that was negative in the back test, what actually makes you decide not to trade a specific market, right? If the performance can't kick it out, what can kick it out?
Likely the only thing that could kick it out, or the most likely thing to kick it out, would be a lack of liquidity. For some reason, the volume has dropped off materially, and maybe I've seen that happen a few times over the years. But
Muni
even if,
bonds, yeah.
yeah, but I pick up some muni bond exposure with a muni bond ETF, so I'm
Yeah.
pretty wily on that. But one of the things that won't kick it out is a new market that's similar to it, because we trade multiple 5-week contracts, and you guys were talking about, I think, different energy contracts,
Yeah.
and they're different. They have different delivery dates. They're slightly different. They're in different countries. We've seen this year the wisdom of trading both coppers, U.S. copper and LME copper. That U.S. copper was a victim of last year's tariffs, and the LME copper behaved much differently. We've seen different performance in Brent crude and WTI crude. And so even if the markets are somewhat correlated, highly correlated most of the time, we still have seen um, big moves come in one of a group of markets that are highly correlated. I mean, we started off by talking about Feb heating oil. Within the same market, we had different performance, not Jan, not March. It had to be February. So certainly within markets that are usually 80% correlated, let's say, you can still get one of those markets, and only one, to have a really big outlier trend and make it worth holding if that's your bottom line. And that's our bottom line. It's not smoothness, because we would only trade maybe 1 or 2 energy contracts.
Yeah.
We're out there trying to find the big moves, and they can come in a group of correlated markets. One market out of a few can have the big trend.
It strikes me as right. It was almost a bear market in diversification for many years as we became more globalized, and you could have WTI be the benchmark. And now as you move to wars and straits closing and tariffs, like we're deglobalizing, in each of these independent markets will perhaps become a little more important. I don't know if you just want to agree with that in the sake of
I
time,
do.
or say,
I
yeah.
do want to agree with that.
All right, we got one more. This is an easy answer. From Wayne. I love the TFPN concept. Had substantial allocation to it for some time now. I'm pretty sure I know the answer, but I'm compelled to ask. As investors, and I think John already answered this, but as investors, can we be sure that TFPN will always continue to be classic trend following only?
Wow. I mean, I'm trying to think of how that could possibly not be true.
Yeah.
I mean, that is good. I love that question. It's the best question, because that's right. Put me to the test. Yeah, I don't see how that could be possible. I think that if trend follow, I met a famous trader one time, very famous. Everyone knows him. I went over to London. I met him. He hosted me, and the first thing he said was, "I'm trying to figure out what I'm going to do when trend following stops working."
Mm.
And this was in the early 2000s. And I said, "Oh, when trend following stops working, then that's when I'm going to stop trading." So yeah, if classic stops working, then I'll let you know. But the sign will be I'll retire.
Was it David Harding?
It was. It
See,
was, and he acted on that, and
he did. He
it's
like changed his stripes, not to a good result.
no.
Sorry, let me read real quick. All right, this was my futuristic one, which could lead into that question. Do you think the introduction of AI will help or hurt trend following as it becomes more and more prevalent?
I think it won't hurt it. Uh, don't think AI is set up to hold positions for a long period of time and predict COVID or predict a war. Um, but I think it's going to help quite a bit in just research, analyzing, uh, choosing better portfolios, not over optimizing. But it's definitely. I've had long discussions with AI about how to improve my trend following, and it's come up with some really good ideas. So I think that is the way to go. But I doubt if it's going to be a good competitor. I've often said that the last step for AI is probably, as it goes through all of its decision making, probably the best thing for AI to do is to say, okay, this is a trade as soon as it hits the 50-day high. So nothing's going to beat sort of timing and getting your risk under control as adding a little trend to almost anything.
John, you got any thoughts on that one?
Yeah, I mean, that's a good question. I think it may help you devise a trend following system faster, but I don't think it's going to help the human sit with it any better. That's the key. I mean, the key part of the reason that we apply trend to everything in various ways, TFPN being a big part of that, is if somebody's after an 8% return for the next 25 years in order to meet their goals, the last thing you want them to do if you're trying to help them get there is to jump off the ride prematurely. And, we're our own worst enemy in investing. So I don't think it's going to improve behavior in the ride. It may improve your ability to devise your own ride, but I don't think it's going to improve behavior during the ride. I also think I'm a little bit dubious of how AI would answer the portfolio construction question, both from a systems perspective and an asset class perspective, because I think what it would
It would kick out Coco for sure.
Well, it would kick out it potentially would kick out trend following, because I think it depends on how far back it looks. So if AI is, looking at optimizing a portfolio and it looks this time last year, it's kicking trend following.
Right.
Or it's likely to, right? If it's because it's going to do all the classic things because it only knows what it's fed. So it's going to look at all the classic ways of building a portfolio. It's going to go to the efficient frontier, and it's going to put together some amalgam of traditional asset classes and probably use one of the convergent alt strategies like private credit or something like that, which, like you described earlier, Jeff, goes staircase up, elevator down. Those are my words, but that's what you described. And then say, like a lot of other people do, when those bear markets happen, don't do anything, bite on a towel and just wait, and it'll come back like it always does. And so I'm not even sure it would include, I think both from a quantitative perspective, depending on the look back window, and a behavioral perspective from the other end, I think AI may kick trend following out completely, which encourages me a ton.
I got two thoughts on that. If I can share one, I think it'll increase trendiness because you'll have people like, what's going on with Coco? And instead of needing to get a hold of some expert that could actually explain it, it's like, boom, gives you the info, and then they might want to get involved. So I think it'll push momentum. And then my second thing is, if you just sat down, and might try this when we hang up, be like, hey, I'm a little worried about inflation, so I want to have exposure to commodities if they pop up. If I'm paying more at the gas pump, I want to own gold when it's going up. Oh, and by the way, if stocks take a tumble, I want to be able to go short those, and I want to capture big momentum moves in stocks. What should I do? Right? What it's going to come up with this. It's going to be like, hopefully it'll just say TFPN, boom. But right, it's going to say something along the lines of like, you should trend following all this stuff because you're concerned about both sides of the market. plus. Yeah, so that would be my last one. Two things before. Can you guys still hear me? My mic went out a little bit.
Yes.
Yeah, sorry. Two things. One, we put in the chat here. We've actually done a couple pods with Jerry on my podcast, The Derivative, and one with John. So we put the links to both of those if you guys can't get enough of our pretty faces and want to hear/view those. Go click those links. And then secondly, we've got or John, just real quick for that, everyone, like TFPN, where do they get it? Anywhere you can put in a symbol? What's that look like?
You could certainly go to the Google machine and fire up TFPN and get your fill.
Done. All right. And then last question, which I think is kind of fun, even though it doesn't quite apply. He's like slightly broader than today's topic. But Jerry, if you were 29 again and trying to break into trend following with no industry connections, what would your first 12 months look like? It's a tough one because you had to answer the Turtle Trader ad.
Well, I think there's a lot of good information out there, like podcasts and webinars like this one. And I would try to copy trend followers. People get on these podcasts and webinars and they say too much. They tell you too many good secrets. So start listening and build up your knowledge, and over time create your way of looking at trend and the markets, and open up an account and start losing money quickly as possible. Pay your dues, pay your tuition to the markets, and trade small, but get out there and see what it's like to follow trends and watch big profits turn into losses. See if you can handle it. Do not ever, this is my biggest pet peeve. Yeah, but it's at the very end, so no one's going to be able
And
to
you got a
disagree
lot
with
of
me.
pets.
Yeah, no one's going to be able to disagree with me. We're out of time. And that is, do not ever think that you should create a strategy that makes you feel good, that suits your personality. Try to create a strategy that is so hard to do, you dislike it. Instead of 40% winning trades, it's 25% winning trades. Instead of getting out at the 100-day low, you get out at the 200-day low. You're willing to give back even more profit to stay in the gear with the big long-term trends. Embrace the pain and suffering, and don't even think about having a smooth return. And you're on the way to possibly creating a systematic strategy that would make money and last a long time if you embrace pain and not ease comfort and pleasure.
Love that. So I think we will
Yes.
leave it there. Great answer. Thank you, Jerry. Thank you, John. Thank you, everyone, for attending. We'll be sending out the recording to your emails and confirming attendees and sending them their lunch gift certificate and all that, plus more information on TFPN. We'll say goodbye to Banana too. See you, Banana.
Thank you, Jeff. Thank you,
All right.
RCM.
Yeah. Thank you, guys.